Hello and welcome to another episode of The Big Perspective, where we talk to some of the smartest minds in the Indian markets and pick their brains about the biggest trends shaping the Indian markets.
The customer has to pay for it. So if you're willing to absorb that inflation, why won't these companies pay for it?
I'm your host, Bhavya Dua. In today's episode, we have Kenneth Andrade, founder and chief investment officer of Oilbridge Capital. And we are going to discuss steel, energy, oil, and much more about markets with him.
So the backbone of this country is always going to be the lending business of financials. I'm not taking it away from them.
Prior to founding Oilbridge Capital Management in December 2015, Kenneth was Chief Investment Officer at IDFC Asset Management, where he was responsible for building the firm's equity franchisee and managed one of India's largest equity funds by AUM. And today, he's sharing his market expertise with us. So let's get going. All right. Thank you so much, Kenneth, for being on another show of The Big Perspective with us. So here we're going to be discussing everything about your investment philosophy, your investment strategies, looking at certain sectors, looking at commodities, and looking at how anyone who is new to investing can really understand what really goes on behind and actually how to view investing for themselves. But the first one, we'll start that you've mentioned you have been in the investing space for quite some time, in the investing world for quite some time. You have been focusing on capital efficient business models is what you have said. Could you tell us what a capital efficient business model is?
We all invest for a certain return. Okay, the return has to be over your cost of capital. It has to beat inflation. And it has to be relevant enough to enjoy a profit margin, which is extraordinary at points in time. It normalizes over long-term periods. So that's really capital efficiency. It has to be over inflation and over cost of capital. And that what determines what a good investment is all about. Now, business has long-term cycles, right? And long-term cycles give you troughs and ebbs and troughs of these capital efficiencies. If you're right at that point of capturing an upcycle in a business cycle, capital efficiencies can be dramatically in your favor for a long period of time.
Right. So a lot of people also focus on high earnings growth when they're looking at the models of the businesses or the sectors that they're interested in. So when you talk about capital efficiency versus high earnings growth, how does that play?
High return on equity can be delivered on two contexts. One is when your profitability grows at a fast rate, which is what your earnings growth is all about. There's the other extreme that can also do is profit remaining constant. Your capital employed in the business comes down.
Right.
The latter that I'm talking about is a derivative on how your capital structure is.
Right.
Your capital structure is equity plus debt.
Yeah, correct.
Okay, and you earn X amount on that equity plus debt.
Correct.
Think about it this way: you collapse your debt. Okay, profit remaining the same, the capital employed in the business comes down. So this is an investment style, and this is what we focus on.
But with what you've mentioned, with the capital employed going down, how does this really work with capital intensive sectors or capital intensive business models like a steel or a cement sector for that matter?
It's the same across every business. I mean, a lot of investors out there look for structural businesses, right? Everything goes up. And at a point in time, everyone used to say that consumers is a structural business. And the macros say this because India has got this population, which is the highest growing population in terms of volume. And all of them will come into the consumption chain. Okay, but take India's largest FMCG business, 4 years has given you no return. There's a period of time between 2000 to 2008, the return on that stock was about 1%. What is structural about that, right? You take any commodity business and the upcycles ROEs of India's largest steel plant in 2008 went to about 45%.
Okay.
ROEs went to 45%, but that's never been replicated back again. So this is the cyclicality of the business, and you just got to capture the ebbs and troughs of both of this and put it together. Now the relevant question is, how do you capture that in a commodity cycle? Okay, wait till things go bad, wait till capacities close down, and wait for the last survivor on the street.
Right. Also, you've mentioned about the structural part of the business. For everyone who is listening to us, can you please explain that, what really that means?
So there's a subset of investors who look for companies that grow 15% per annum in perpetuity. So the most often phrase that is sold to equity investors is that it will give you a 15% return into perpetuity. Okay, but 15% into perpetuity is right, but 15% into perpetuity is wrong to expect 15% every year. Okay.
Correct.
And that's essentially what people try to look for in a company. Which company can give you 15% return or a 10% return every year? There's no such thing that exists.
So, when you're talking about these, I'm going to be asking a lot of dumb questions because this is going to be like a really 101 session with dumb basic questions also. You can complicate your answers and we'll try to simplify that for everyone who is watching. But for example, you're talking about entering a business during a down cycle.
Yeah.
Correct. So what are the factors with which you determine that right now it's the down cycle for, let's say, steel business?
Yeah, take an industry where everyone's losing money, and if one company is making money, that's where it is.
Exactly. Okay.
I think 97, 98, there was one steel company where the enterprise value was 4,500 crores. It had a capacity of about 2 million tons or some such number. And out of 4,500 crores, 4,000 crores was debt, 500 crores was market cap.
Okay.
So effectively an insolvent business. When the cycle turned around, that debt got paid off in 2 years.
Okay.
Something very similar happened to is in the last cycle, where there was one business that went down to almost, it was 7,000 crores of market cap and about 25,000 crores of debt.
Okay.
But when the cycle turned around, the company became debt free.
Got it. So those are the things you...
From an investing perspective, you don't align with those kind of companies. Okay, because when you step into investing, you invest large pools of capital that are there. So you pick the largest company that has got the most efficient process and a much better and healthier balance sheet, and they will be able to navigate that crisis better.
When you say much better and a healthier balance sheet, exactly what other particular metrics we're looking at? Lower debt.
Yeah, lower debt. So when you talk commodities, whether it is energy, whether it is cement or any other infrastructure asset that is in there, one thing is not good for any business is being over leveraged in any market, because you can't time that cycle.
Right. So I'm going to take one step back from here and talk about from a bigger perspective point of view, because India has been pushing for a 5 trillion economy and there's been a lot of infrastructure boost by the government as well. Do you think because of that, steel and cement as sectors are going to take equal precedence going forward?
There will be a demand for it, but you also got to realize India is the second largest producer of steel in the world. Right.
But still a lot backed by China.
But then if you say we are the second and 24% of the world GDP is manufacturing under 100 million tons of steel, how do you put it together? Right. So there is an opportunity out there. I'm not saying there's no opportunity out there, but I think it'll be reasonably predictable. I could say I am pretty sure that we're not going to be anywhere close to the size of China's steel capacity. We're not going there.
And now China is also dumping steel in the country.
When you got excessive capacities, you have to push steel outside your country.
Correct. So in that case, how will India's steel companies stand with so much of cheap imports for steel coming in from China or other countries through FTAs that everyone has been talking about?
I don't think it's a long-term problem, because the same long-term problem emerged in the late 90s. At that point in time, if I remember right, it was Russia that was dumping steel into the market. This time it's another country that is dumping steel into the market. We navigate our way through the entire crisis, and while you say that, someone's dumping steel into our country, but look at the profit margins of some of our businesses. Okay, so it can't be that they are dumping steel into our country at the cost of profitability of our steel industry. Surely profitabilities come up, they come to normal margins, but as investors you make money when there is a super cycle. Okay, so you just have to have patience to see how that evolves itself. So it's not a threat to our industry, but definitely is a threat to profitability.
Got it.
Okay, it's not a threat to our industry, but it's a threat to profitability.
Got it, understood. And also when you talked about these cycles and you talked about the steel industry also in particular, just 2 questions before, you said that one should redefine itself for the next cycle. So for steel particularly, how do you evaluate if a company can actually redefine itself for a next cycle? Is it just that element that you look at?
No, so just look at companies' growth models globally.
Okay.
Pick one that you like and map the company you like in India to see whether they follow something very similar in terms of pattern. So you got to figure out how these companies will grow out of the India problem. Remember, India is 3% of the world's global economy, right? We will go to 6, you'll go to 7% of the world economy. But you got to build a business. I mean, most entrepreneurs need to focus on 100% of the world GDP. You can't make a cost-efficient business by catering to just 3% of the world economy, which is India. You have to create a business which caters to 100% of the world GDP. And that's how any industry, forget steel for a minute, how any industry has to evolve.
Got it. So again, I'm going to club this particular response of yours with the question that we were on
Sure.
before this. So you mentioned about any industry or any company should look at catering to 100% of the global economy, right? Not just 3% of what we currently look at. And also with current China dumping its steel around, how do you think the steel players right now can take certain structural advantages for these Indian companies to actually take advantage over the others exporters from China?
Yeah, very simple. You have to work on cost.
Yeah.
There's the other thing also. You can't have high steel prices because it impacts your exports of everything else. Steel is the foundation of everything else you do. Okay, if you keep elevated prices of the metal in India, the other industries get non-competitive.
Correct.
So why is China competitive? Your base material industry is subsidizing everything else in the economy, right? And that's how you create franchises which are very competitive in the rest of the world. It's not a like-to-like model, but why does Indian IT succeed? Cheap cost of raw material, right?
Right.
What we do? We arbitrage global per capita incomes with India per capita incomes.
Yeah.
That arbitrage is a profit pool. Okay. If you have to be large in, say, sale of cars, which the Chinese are as far as EVs, what's your base raw material that goes into it?
Right.
Okay, I'm not talking steel here. Okay, what's your base raw material? If those companies are enormously profitable, I mean, the other extreme is that you do not get a globally competitive industry in your user base.
Right.
So it's not something that's very easy to solve because first you have to put in capacity, you have to create surplus capacities, you have got to create another industry that uses those capacities.
Right.
And between that entire value chain, you have to be globally competitive. That's how you address the rest of the world. So you need a strong foundation of infrastructure so that logistics costs come down. You need a strong foundation in terms of your material base, your primary material base that goes into manufacturing, and that's when you go into become competitive worldwide.
And also, I'll just quickly add another point here, which I want you to address. Does Vietnam picking up steel production also is a challenge that India looks at currently?
I'm not so sure that's going to be very relevant.
Okay. Why so?
We are the second largest world producers of steel, and we've got capacity expansions which are coming up very significantly. Second is we are very integrated in manufacturing. We've got our own iron ore, we've got our own coal. The only thing that we import is met coke. That has its ebbs and flows in terms of where capacities come in. So if commodity prices go up, production also, met coke goes up across the world. So in terms of the cost base, I think we are almost there.
Okay.
Okay. I don't think anyone can beat us as far as the cost base is concerned.
Got it. And if we look at CBAM currently, that's another challenge that the steel manufacturers currently are facing. How do you think we can find a way through these global challenges like CBAM?
I mean, everyone's aware of it. If you ban products coming from one country, it finds its way into your country one way or the other. I'm sure that we'll find a way through the entire production pipeline into those parts of the world. So as much as you want to put tariffs, direct or indirect, into a product, into your imports, you got to realize that all of this is inflationary. And inflation is very politically motivated. So how much of inflation can a country take? Yeah, those are questions that are not yet answered. So the minute you implement it and see how it goes, including tariff barriers that are coming across the world. Once you put that together, we'll need to see how much of inflation can the rest of the world actually take. Because it is going to be an inflationary decade for sure.
Correct. Till the time that does not really happen, do you think the Indian companies are competitive enough to find a way through it? Or are there any immediate compliance steps also that they should prioritize in order to deal with it?
You can't do much. I mean, someone's got to pay for green steel, right?
Yeah.
Who's going to pay for green steel? Which automaker is going to pay for green steel? Anyway, Europe is seeing multiple shutdowns at its production lines. Okay, the Americans have lost market share significantly. Technology is not moving anywhere in these two countries as far as production of technology in most of the capital goods, etc. It's not moving significantly in any of these countries. But their infrastructure rollouts are massive. So someone's got to pay for it. I wouldn't have the answer as whether we're competitive or not with tariffs, but I'm definitely sure we're one of the lowest cost producers of commodities in the world.
Correct. So if you look at these Indian steel makers, they're also predominantly reliant on blast furnace route. And the scrap availability is very limited in our country. So, what changes do you foresee to accelerate the transition to a low emission production?
Nothing. We are very far away from it. For a circular economy, you have to be a large economy. You've got to have that base of production and scrap to recycle it. India's never been there before. Okay, with a per capita income of under $3,000, you're not producing enough of material to get recycled. So you have to create a primary base of material, create infrastructure, and then maybe after 20 years you get a secondary steel manufacturing boost.
So again, green steel you mentioned, it has become an even more hot topic after COP28, right? So with hydrogen-based production still nascent in India, do you see early movers? No?
It's too far out for my tiny little brain.
If we talk about Tata Steel and JSW, who are the leading market players in steel, what characteristics or metrics should investors look at to identify smaller players with significant upside potential?
No. Why would you want to invest in steel first? One of the largest steel mills is part of our portfolio, and that's in public domain. Okay, we like that business not because it manufactures steel.
Right.
We basically think over the course of the next 4 or 5 years, it'll be a company which will double capacity. It's a business that will have no debt on book.
Okay.
And cash flows in excess of 30,000 crores. Okay, and this is at very nominal profitability margin. EBITDA per ton for this industry again has ranged between 10,000 rupees per ton to about 23,000 rupees a ton. It's gone higher for a very brief period. And we're somewhere around 15,000 rupees a ton just now. We're scraping the bottom. But remember, we're still profitable. So if you get one good upcycle, all the debt disappears. And that's the best thing ever that can happen to any business.
Got it. And again, I'm going to go back to China because we talk about China's huge slowdown in consumption and massive production capacities. So importing that deflation is always a risk. So are current valuations of the companies pricing in that kind of a risk?
So there are two ways you import deflation. You let your currency appreciate against the other currency, which we are not letting it happen.
Correct.
So we're not importing real deflation. And secondly, you allow for free imports of every product into the country. And there are very soft barriers that have come up to import products into our country. You will have steel coming into the country, but they're usually grades of steel which are not manufactured in India. So there's a lot of hue and cry around it, but I don't think it's as severe steel imports that people are making it out to be.
Okay. So you don't think this is a risk that people
They're
should
profitable.
be concerned about?
We just have to wait for a cycle. You have to be patient in investing.
Right. Got it. Now I'm again going to bring you back to cement and steel. So now cement and steel often go hand in hand when we talk about infrastructure projects. So should investors view these as integrated opportunities, or should any two sectors be evaluated completely separately?
So again, I'll take you away from that and bring you to financial ratios. You just look for efficient capital, right?
Right.
Why do you have to invest in steel or cement or both or the third one? I mean, at the end of the day, cement has its own cycle and steel has its own cycle. I mean, you've seen the best in terms of valuations of cement. All of them used to trade at least 2x, 2.5x of their replacement cost. That no longer holds true. So effectively, it also means that given the capacities that are there on the ground, there is enough and more capacities that are there on the ground, and you will see pricing normalize. So India, about 3 years or 4 years back, had some of the most expensively priced cement companies in the world. I think that's all normalizing right now. They're still not cheap compared to the rest of the world averages, but that's all averaging right now.
And also, cement companies in India have been investing in alternative fuels and also waste heat recovery to cut costs and emissions. How should one view those sorts of initiatives?
They just cost control measures, and when they first start, there are new ways of doing things, and then it just starts as a momentum. And if it saves you cost per ton of cement and adds to your profitability, I can't see any reason why anyone should not do it.
Right.
So I don't think it's really a green initiative while it acts as one, but it definitely has a high ROI on the financial numbers also.
Do you think steel could follow a similar path?
Well, globally they have. Globally they've gone into recycling quite a bit. So manufacturing steel out of scrap and manufacturing steel out of iron ore, there are two big deviations that are there. Cement is a less capital intensive business. It's not as capital intensive as steel is, but it's also got a significantly lower realization per ton. Okay, Will steel follow cement? If it works for them, they will definitely do it.
And then you've also talked about how balancing traditional industries with new age opportunities. So if we talk about power, it's majorly focused on coal-driven growth. Or is a pivot towards renewable more prudent in that particular domain?
For a long time, power was a centralized industry, you had few power manufacturers
Correct.
across the country. With all these new technologies coming through, you have that industry fragmenting at a pace that we've never seen before. You have a lot of these smaller hydro power plants in the first round. Now then you had wind turbines getting set up, and now you've got solar plants getting set up, and then you'll have the next wave that will come through, whatever it might be. So how do you participate in an industry which is putting up capacities at a breakneck speed, and there are multiple participants to all of them?
Okay.
I think that's where the opportunity set lies. While they have pricing power only when there is a supply deficit and demand is high, it's not an industry wherein you can price your product because you're selling better power. It's got no pricing power. It's a commodity. It's a plain, simple commodity. So when you fragment a capacity that is there and everyone becomes a net seller or net buyer at the same time, okay, you got to try and capture that opportunity.
But again, do you think a pivot to renewables is more prudent at this point in time?
From a global context, from a climate context, yes and no. It seems to be bringing in a lot of green energy, so as to say. Okay, but to bring that capacity in, you're creating something. You're getting it from somewhere else. So yes, it's good for the global economy in the longer term when you shift out there, because there are no greenhouse gases emissions once all these power plants are out there.
Correct.
And since renewables is got virtually zero running cost, your cost structure also comes down after the plants are fully depreciated and they do not have debt on their books. After a 10-15 year period, these units become deflationary in nature because there's no cost there. And just wait for surplus capacities to build out.
Yeah.
That's very critical because step back into 2013 and 14.
Okay,
and that's where India went surplus power. And for 6 years, plants closed down. Plants never got completed. Tariffs went to 2.5 to 3.25 for a very long period of time, till demand outstripped supply.
Right. So now, do you think a situation like this can happen because the demand is set to rise only, like by another 35% by 2035, or do you think a situation like that is likely?
See, we will never fall short of steel, cement. Okay, power still has to catch up, but I don't think after a certain period of time we will fall short of power either. So there's enough of demand, it's supply coming up to meet that number that we talked about, 35%. Now, how they will come out, whether it will come up in the conventional thermal, hydel, renewable, nuclear,
We don't know.
I don't have the answer. Yes.
So when we're looking at the energy demand in India, where do the compelling opportunities really lie in power generation, transmission, or renewables?
We just got one exposure to the energy sector, which is an exchange. So when you have fragmentation of capacity, there are a lot of capacities for sale. At the other extreme, as the buyers also fragment and buyers have access to open market, you got both extremes of a marketplace which can be catered to. It's very similar to the capital market.
Got it.
That's why we have our energy exposure to.
Again, talking about energy and renewables. Solar and wind, as we discussed, are growing, but storage and grid capacity still have their bottlenecks. So how do we see, when we are looking at power or energy sector, this being a challenge for another few years?
It will be for some time, but everyone's working on their problems. I mean, US has got an older grid than India has, significantly older grid than India has, and there's a massive capex outlay that's coming out there. Same thing holds true for Europe, and some part of it is holding true for India. But from what I sense in terms of the rollout of orders, as far as the India context is concerned, most of those bottlenecks issues are getting addressed, and modernization and bottlenecks issues are getting addressed. There will be a particular year or two where some product will be in short supply, and that's why you'll have abnormal cycles that will be there. But that gets addressed very soon in the next 2 years as all businesses expand.
Got it. So any person who is looking at this sector currently should not actually worry about this being a big challenge.
I go back to say, why do you need to only invest in power or steel or cement? Okay, I think the whole marketplace is out there. You got to find whether it's efficient. In any industry, and especially the one that you're talking about, when we talk about investment into a capacity, the basic financial model is that your denominator is increasing, your capital employed is increasing.
Correct.
Right? To put the plant in place, you need to borrow money or you need to raise capital.
Correct.
And your profits is going to be back-ended. So these are utilities. They don't make disproportionate amount of money.
Okay.
They make it in a market cycle or two. I think in 2006 and 7 they made enormous amount of money. Half of them went bankrupt. And you will have these interplays in capital-intensive sectors happening at all points in time. When I was learning how to invest money, or when I was looking at capex cycles, a normal capex cycles used to be like if denominator is going up faster than numerator, if capital employed is going up faster than profitability,
Correct.
the stock does nothing for a long period of time. Okay, I'll take you back again to another industry which is very commoditized, which is chemicals. Everyone asked me about what to do with chemicals in 2021 and 22. The problem was India expanded its chemical capacity. China also did the same. Now when you're talking dumping, why do they dump? Because capacity is already in place. I have to continue to sell. If I hold inventory, it costs money.
Correct.
Because I have to pay interest costs. And if I sell at marketplace, okay, I'm realizing cash, but I'm not making a profit. That's why profit margins collapse.
Correct.
Right? Now when you set up a power plant, or you set up a steel plant, or you put a cement plant, remember your denominator is expanding at a furious pace.
Correct.
But are you doing it by yourself, or are you looking at what your competitor is doing and the competitor after that is doing and the rest of the world is also implementing? So Europe is decreasing capacity, India is expanding capacity in steel. So yes, maybe that industry has a chance wherein profitability will remain stagnant or will grow. Cement, it's 1:1. In power, you've got a very high denominator coming in. I don't have a visibility after 5 years what it's going to be.
So similarly, if we talk about oil in the same example, then how do you view something which is oil and natural gas? What's happening to those companies in India currently in terms of the capital expansion? Where is the denominator going for them?
No, it's not the denominator. The denominator is the asset that you have. So remember, it's a mining business.
Yeah.
The asset that you have on the ground, the terminal value is zero once everything is evacuated.
Correct.
Okay, and if everyone is moving to renewables, everyone who's sitting on those fuels know that the terminal value is zero. And everyone's in a rush to evacuate it.
Correct.
Okay, so if you see gas prices that are there, and the rush between the US and the Middle East and everyone who can find a gas find to evacuate it first, because first to market, because I get some realization whether it's $1, $2, $3 per MMBTU. And that's what's happening in the gas price. And similar stuff for oil. But in terms of motor spirit, that's not a market that's growing.
And even with the Russia-Ukraine war and whatever has been going on with the OPEC production strategies also.
We've had everything. I don't think we've seen any inflationary pressure as far as oil is concerned.
And then if we talk about gas, then India is also pushing for greater adoption of LNG as a transition fuel. So do you see this as a significant opportunity for investors, or does it remain overshadowed by traditional crude oil players?
I bumped into one of the international traders in gas once at one of the airports, and he said that Indians are very particular on the price they pay for gas. Okay, gas prices go up, they get out of the market. If gas prices come in, they come into the marketplace. So if you're going to be that sensitive, it's going to be very cyclical in how you're going to consume that product.
But isn't that true for oil also?
No, oil runs our economy.
Yeah.
Okay, gas can be substituted.
Correct.
Okay, with oil or coal or everything else.
So then do we see a significant opportunity in LNG as a space?
We don't have any company that owns significant amount of gas blocks. So the source is gone. You've got a lot of them on the coast which are LNG terminals. So they import LNG and they put it into the marketplace. And then you have the gas distribution companies, where now it's all an even playing field within everyone. No one gets subsidized gas from the government anymore. And there, given where valuations stand, I think there might be an opportunity out there. But it's not an industry that's going to hit the ball out of the park. Again, these are all utilities in nature. They're all utility businesses.
So with all the things that you've talked about right now, whether it's steel, cement, oil, natural gas, and when you talk about the current valuations, where do you see it?
Steel is okay for the risk that you want to take on that. Cement, I'm not too sure. I think that it's an industry which is always fairly well priced. Maybe the largest cement company in the country might have an edge as he consolidates more because it's a company that throws an enormous amount of cash. So if he can get more capacities cheaper and increase his dominance at a particular point in time, he'll have pricing. If that continues. So that's a maybe. But when it comes to oil and gas, you'll have to wait for things to get very cheap, which is what they are now. So valuation wise, oil and gas is as low as it can get. Cement, I'm not too sure. We don't have a bias on that. And steel also is quite okay.
Got it.
We like businesses that have a lot of cash flows and manageable debt. So this is an industry that we'd like to see in our portfolio for a while.
So cash flows and debt is what you majorly look at across industries where you invest.
Look, we are investors. Okay, we're not setting up steel plants or power plants.
Correct.
Right. We got to maximize their profitability on our portfolios. And if we are comfortable with that, we are present in most of them.
Got it. I'm again going to go back to you highlighting efficient capital. With a lot of these industries, especially steel and cement, having to focus on decarbonization costs, do you think they'll be able to maintain that efficient capital?
Someone's got to pay for decarbonization costs. These companies are not going to pay for it.
Who pays for it?
The customer has to pay for it. So if you're willing to absorb that inflation, why won't these companies pay for it? But if you're not willing to absorb the inflation, no one's going to implement it ahead of the cycle because no one wants to lose competitive intensity. I just bring you back to that one statement that we keep saying, efficient capital. Look, efficient capital, every investor wants to buy efficient capital. That's the hygiene of our industry, right?
Yeah.
So I'm not saying anything which is very different from what we're supposed to do.
Also, again, when we talk about, I'm talking about decarbonization, net zero, all these things time and again. So India's commitment to net zero is under scrutiny post the COP28. So do you think the steel sector can realistically contribute to these goals while maintaining profitability? Or again, it depends on someone needs to pay for it, otherwise it will be too ahead of the curve?
Steel throws out 2.5 kgs of carbon dioxide per kg of steel. I mean, changing that metric is going to take a lot of effort. I don't know how we're going to do it.
And do you see a green premium emerging for Indian steel and power companies that lead in sustainable practices? Would investors be willing to pay a premium for that going forward, since those are the global mandates?
So if you go back about 3-4 years, ESG was a very sort of trend at that point in time, right? Today, it's not so. It's lost its premium. I can say about today, if that reverses itself and the world's largest economy says no, okay, I think it will lose its near-term investment popularity.
So only if that trend reverses is...
Yes.
Otherwise, right now, no.
I don't think it's coming back as a fashion very soon.
Got it. Again, a question that I touched base upon in the beginning, I want to ask an add-on thing to that. We talked about China dumping steel, right? Its own steel demand is also plateauing. That's why it's dumping steel outside. So do you think its export-driven strategy will permanently disrupt global markets, or as you said initially about its impact on India, that it's a short-term phenomenon?
I mean, if you keep selling anything at a loss, those capacities necessarily need to close down. It happened with one of any country that dumps steel into the market lower than their cost base. It doesn't have a significant economic advantage vis-a-vis the other players.
And how will the global supply chains be impacted because of that?
Not significantly. I think China built out a large manufacturing base for everything. And that's where most of the steel got consumed. So one way or the other, steel used to hit the international market through their manufacturing base, which is why they are 1 billion tons plus of steel capacities. So manufacturing slowdown in China is creating surpluses in basic primary materials.
Yeah.
Which is coming into the rest of the world.
Correct.
In one way, a slowdown in the rest of the world is creating deflation in China, which is throwing out material or base material from
cheaper costs.
In some format, we've seen the cycle previously in financial history. The Great Depression that was there in the US, that essentially came through because Europe slowed down. So Europe slowed down, manufacturing base was US went into a Great Depression. And something very similar is playing out in today's context.
Makes sense. So when you're talking about these interrelations between different economies globally, Again, if we talk about energy in that sense, there's nationality angle coming when we talk about energy.
Energy security and food security. Yeah.
Yes. So then US and UK are both focusing on domestic production. So where does that, what opportunities or risks does that leave for Indian energy exporters?
Yeah. Ouch. You've taken me off my course rank of trying to pick good companies to discussing international trade. I have no idea.
We were discussing companies and now we're just like zooming out for the bigger perspective.
No. I don't have that big a perspective to it all. I can tell you about individual companies, their cost sheets, and how they manage the rest of the world. Okay, but what nations do with their production capacities, it's a little difficult to put together.
That's what opportunities or risks for the Indian exporters?
No, I think we're just creating a manufacturing base to export the other products out. So India is a very large exporter of two-wheelers, right? What is your base material? Engineering, manpower, and commodities. If India emerges as a net exporter of cars, which is the small cars, which every single car company is talking about.
Yeah.
Okay, what is the net? What is your base material for all of that coming through India? So you got to look at it in that context. So today we've got a lot of PLI schemes that are there for a lot of manufacturing capacities of the country. Now if all the iPhones of a certain model are going out of the India factory, what are the raw materials for all of that? Where is it coming out of? So you see the correlation between primary metals or primary commoditized businesses in India and our export competitiveness across the world. I think that's something we tend to watch a little more than everything else.
Got it.
But again, we're stuck because we don't spend too much of time on this part of the world.
And you also mentioned that you can tell what certain companies are doing in terms of to have that competitive edge in the current scenario.
Yeah, it's just work on cost. I mean, you get up in the morning, you say which cost you want to cut. And then there's two things in business. One is the market determines the profitability. The management determines the cost. If the market takes the prices of your commodity higher and management continues to work on cost, my margins go higher.
Correct.
So if anyone asks a simple question, you go to all analyst meets and all analysts, because everyone is asking how much margins are you making? Okay, it's all there in last year's balance sheets. Because all cost initiatives are mentioned in management discussions. If they're not, it's a very poorly crafted annual report. But that's the only thing that a management does, right? And if selling price is here and your cost base is here, if selling price drops and you can drop your cost base, you're doing everything that the management is supposed to do to stay competitive,
right,
or to stay solvent. So I think that's essentially what a commodity business is all about.
Got it. And there are players who are doing this efficiently?
Oh, everyone's doing it. There are a lot of people who are working on business models that make them competitive and keep them competitive. So it's labor, interest cost, capital cost, and your procurement cost of raw materials. Everything works.
Got it. So we're going to go back again to your investment strategies, but also keep like a few sectors in focus while discussing about your strategies as well. So you've discussed about investing in businesses that redefine themselves post down cycle. Any businesses in any of the sectors that you're closely looking at that have done so?
We have one strategy, which is a focused equity strategy on the mutual fund side. In that strategy, we have about 23 companies. A lot of them in various stages of evolution. Our largest weightage is in pharmaceutical businesses, which are outbound. Now, there are two industries in India which are completely in overcapacity. One is IT, and second is pharmaceuticals. Now, why I say they're in overcapacity is because they sell everything into India, there is no market for it. So they have to be globally competitive. And these guys have established everything over the last 2-3 decades that they've been at it. They've got significant market shares everywhere in the world, whether it's the US or whether it's Europe and there's the rest of the world. And they're very competitive compared to anyone that's actually standing there. So that's our template of how to look at the marketplace, how to look at consolidating industries from India across the world. Pharma, which is about 20% of our portfolio, it's been in our portfolio for, I would say, about 4 years now. I mean, we've migrated from alternates to a mutual fund cycle, but that's been a consistent endeavor to hold a business cycle for a long period of time. So I think that's where we are. And the interesting thing is, and like I say, we have about 4 or 5 companies that are there. The interesting thing is how do these businesses transition in 26 to 30? And that's where the market opportunity actually explodes. When I say explodes, there are a number of drugs coming out of patents, small molecules and large molecules. And that's a marketplace wherein most of the Indian companies are addressing.
Yeah.
Of course, there are some international businesses that are also accessing
Everyone's
them.
been talking about it.
Yes. So what do we look for? We look for a large business which is efficient, not losing money, but yet gaining market share. And the price doesn't reflect that. Okay, and that's what we implemented. From there, we understood as to how to parameterize different companies in the same industry and build complementary companies stroke stocks. Okay.
Okay.
So if I own one X business which is in formulations, I'll own another business which is in OTC. So they don't compete with each other in the same marketplace, right? So you have a very different context of portfolio construction while giving you access to the entire marketplace.
Got it.
Okay, and that's what we've built through with 20% of our portfolio. So that's standing out there. We'll have to see when the profit pool expands in that industry, how much of that profit comes to the companies that we own. Now, while saying that, look, it's an industry where everyone will do well. So the profit template of that industry will go up. Some of the companies that we don't have might do better, but as long as I've got 20% of our portfolio doing better than the rest of the market, our portfolio is in play.
So again, this was going to be my question. Since you said most of the companies will do good, how do you actually choose from that? Because before this, we discussed that if, for example, in an industry, out of 20 companies, only one is doing good, you have a clear-cut answer for you. But in an industry where most companies are doing good or everyone is doing good,
will
how
do
do you?
good. Okay. Thing is, when we talked about consolidation or we talked about commodity consolidation, we were looking at the India context. Here is that you have a subset of Indian companies which are profitable, consolidating global market shares. So if you look at the generic businesses in the US or the generic companies in the US, they have one problem across the board. All of them are loaded up with debt. Okay, and all of them took debt when interest rates were like low single digits. I mean, actually low single digits, close to 1.5%, 2%. When that came up for repricing, they had a cost line they couldn't manage. And the Indian counterparts had cash on balance sheet. A similar format played out in 2000 to 2010, wherein the IT companies, the IT services companies did exactly the same thing in IT services where the Western businesses actually were leveraged. Okay, so you just take a template, see where the companies are, what the Indian businesses are doing, go ahead and work that template out.
Got it.
Okay. Now when profit expands, then we'll have to see how stock prices play out.
Got it. And again, now these are the two sectors that companies have been able to redefine themselves post a down cycle. What are the sectors where that hasn't happened and because of that you've neglected those?
So the indices have 6% in pharma.
Okay.
We've got 20%.
Yeah.
The indices have 30% in lending businesses and banks. We've got 6%. The consumer format is very large as far as indices are concerned. We're virtually not present there.
What is it that you see there?
When it comes to financials, right? When it comes to the lending businesses, one big part of the market, which is corporate India. Okay, and if you look at corporate India's solvency ratios, okay, they're the best that there's ever been before. So we map it on an NSE 500 basis. The top 500 companies in India is lower than State Bank of India's lending book.
Okay.
30% of India's GDP, which is your top 500 companies which are listed, their gross debt is lower than SBI's lending book. Banks have no pricing power when they address corporate India.
Correct.
Now, all of this is higher risk to stay in the same place.
Yeah.
You're maintaining your historical growth, but you're taking more risk to maintain a historical growth, right? And you're taking that. And at the same time, you've got a part of the market that never existed come back into competition, which is the public sector banks. So they were struggling with capital adequacy some time back. Today, they don't have to worry about it. So the competitive landscape has increased. Your margins are actually tight. You're still very profitable. But why should I give you valuations for a 14-15% ROE business when the other part of the market is doing much better? And that's how the landscape is moving.
Got it. So this is about the lending business. You also mentioned about the consumer side. What's happening there?
You've seen it in the news, right? So it's a simple case of inflation. It's a simple case of leverage. So two things that take away from incomes. One is inflation and one is leverage.
Correct.
Because my EMIs go up.
Yeah.
And then I have lesser disposable income. That's a dangerous cocktail. It's not happening with the Indian consumer, it's happening to consumers worldwide. So when you have lower disposable income and high leverage, and that's when you see the start of the correction of the consumer cycle.
Correct.
Household debt is at its all-time high. In India, it's definitely at its all-time high. Globally, it's also somewhere there. And you will see that tear down through almost this entire decade.
Yeah. So consumer business is the one that's going to take.
No, so I would also say that this is our point of view of why we have 6% in the lending business and not 30% compared to where the benchmarks are. And we have 20% in pharmaceuticals, who is consolidating the market globally, and where the indices are at 6%. So if you put profitability of both these industries, okay, and assuming this is financials and this is pharmaceuticals, financials might move like this and pharmaceuticals move like this, which changes the ratio of the indices. So the backbone of this country is always going to be the lending business of financials. I'm not taking it away from them, but we think that there is enough and more opportunity that's outside the marketplace. In most of our communication with in investors, we highlight the fact that a good company, okay, you have a lot of good banks out there. A good company is not always a good stock. Okay, and you got to try and differentiate that. Don't look at the last 5-year returns, okay, to project the next 5 year. Okay, that's the most dangerous thing to do.
How can someone project the next 5 years for anyone who is trying to understand this?
Don't. Actually, we don't. It's not our core strength.
Yeah.
If you ask me to project the next 5-year return, next 5-year growth rates of any of these industries, we will give you a summation of probably the sell side of most of the economists are giving you. We don't focus so much on that. We just focus on what we can see, which is the supply side of the industry. And the supply side of the industry is there in the quantum of how much that industry is putting capital to work.
So when you talked about these two particular sectors, that the weightage that you have is lower than the indices weightage, but you still are holding certain amount of it. So in that case, how do you identify a good stock?
We just look at that business gaining market share. That's about it. And not spending too much of money of gaining or maintaining market share. That's all we need to do. But you'd have to have a lot of patience, I mean, with some of these names. I can't go out and say that wait for 5 years and in the 5th year, all your returns will come from that industry. That's not the way it works.
And now another thing that you've mentioned about, and again, we've discussed that in the beginning also, you've emphasized the importance of timing cycles in cyclical industries. So what mistakes do investors often make while navigating through different sectors?
So I think momentum is one of the most popular investing trends that a normal investor aligns to. It's profitable till you get caught at the wrong end of the stick. When we try to define our investment cycle or investment philosophy, we say capital efficiency at a price. The latter is very, very important.
Right.
So this value versus growth, growth versus value.
Yeah.
My historical experience has always been value turns to growth. Okay, value will remain value till growth kicks in. So today's growth stocks are not what yesterday's growth stocks were.
Correct.
Right? Last decade's growth stock was all the consumer businesses and all the NBFC financials, etc., etc. Today's growth stocks are completely the opposite. They are the next par utility businesses, they're the next par, the next capital good businesses, etc. But all of them came when they were extremely cheap. One of India's larger energy businesses went 0.6 times price to book. Today it trades at 8 times price to book. Now think of the amount of money you made just by expansion of the price to book multiple or the price to earning multiple. So be very careful when you're making money because your price earning multiple is expanding. So there are two expansions that help you make money. One is profit expansion. And price earning multiple expansion. If you get a business which is growing flat, but doing all the right things, but there's no profit, that business is trading at 10 times multiple. Okay, then it hits a sweet spot. Its growth moves to 15% multiple, and 10 times multiple moves to 15 times multiple, moves to 20 times multiple. So how do you compound value? Get a combination of growth and multiples, and expansion of multiples.
And again, if we go back to what we started with, let's say these industries, these sectors like steel, cement, in that case, how do you actually navigate this?
Oh, that's easy. So if you've seen one steel cycle, you know you'll see it again. If you've seen that one, then it becomes, or when one commodity cycle. So a bad commodity cycle, a lot of companies end up with working capital, which shows up as debt. In a good cycle, that debt becomes cash flow. Cash flow grows faster than profits. Okay, and then the multiples change. In this case, we are at neither end. In this particular industry, we are somewhere in the middle. We are at neither ends of the spectrum. So it's not value, it's not growth.
what is being somewhere in the middle?
It's somewhere in the middle. So it's not in a down cycle because they can sell all they can produce. So they're not collecting inventory.
Correct.
They're expanding capacity. Large part of the capacity is coming out of internal accruals. So that means they're also very profitable.
We again touched upon these points while we were talking about the global scenario. If we talk about inflation and interest rates, significant impact on commodity prices, how do you integrate macroeconomic variables into your investment decisions when it comes? You don't.
We don't.
Why so?
We just talk because, and then we just participate with whatever is happening on the macros. We read macros. My macros are as good as yours. I read the same newspaper. So I don't think we're going to emphasize too much to say that we know a lot of macros. We're just looking at how to enter an entire business, and we think we're fully priced and everything's okay then.
These macros might have a significant impact also, right? So then how do you factor that in?
See, in a good macro condition, okay, a business will trade at 40 times earnings. To say 40 is cheaper than 50, is cheaper than 60, is cheaper than 70, it's my guess that I'm going to ride that cycle.
Yeah.
We may not be in that guessing game there. So for us, it's profitability, the ability to generate profit and the ability to get maximum pricing after a point in time. So previous cycle, like I said, the power utility that's there. We even held a cable company at 10 times earnings. Today it trades at 45 times earnings. I sold it at 30 times earnings. So I don't know which is right. 10 was mispriced. 30 was we thought was fully priced. It's today at 45 times earnings. So as an investor, you got to know, you got to be extremely good at buying or selling. I think I concentrate on the former, which is we just like to get our stock prices right. After that, we let it run.
So like you just mentioned that bought it at 10 times, sold it at 30 times, is currently at 45. What do you look at while exiting a particular investment?
Industry fragmentation, easy availability of capital to the industry, and everyone talking up their own business.
So if that happens in any industry is when you think, with any companies, when you think it's time to?
One of the biggest industries that is in our face and you can see it play out is paints.
Yeah.
4 players, today there are 15.
Right.
And from 4 players to 15 players, the last 11 didn't come in saying that I'm going to lose money.
And then you also mentioned about things like Make in India, PLI. And with that, Make in India has been on focus in India's manufacturing segment. So with schemes like this, which are set to drive the commodity demand, which subsectors do you think will benefit the most and benefit directly from these sorts of schemes?
I think employment.
Okay. Because a lot of labor-intensive sectors are going to...
See, the broader context of the India economy is that your per capita income is moving upwards. It's going to move from $2,500 upwards to a certain number. But it can only move if you import inflation.
Yeah.
Which means you have an export product. And once you get that per capita income higher, then there's an entire industry which is domestically driven, which will start doing well.
And again, I'm going to go back to the similar things we've been discussing. There has been a downgrade in the earnings across market. So are you seeing opportunities in some industries like capital market plays, or are we keeping earnings growth far away from ourselves while...
No. We love companies at 52-week lows. Okay, and we like stress in the entire business. So all the microfinance businesses are down below one time price to book, except for some of the better ones. Some of the private sector banks are down to 1 time price to book. Chemical companies haven't done anything for like 5 years in a row. So it's not that we do not have ideation around all of this. We definitely have to. We definitely out there looking for ideas and stuff. But the simple process is like look for 52-week lows when you're adding a new business, and look for 52-week high all-time highs when you're exiting a business.
So when you're looking at 52 weeks lows is where you see a growth potential in their earnings.
No, I'm looking at safety of capital.
So how do you identify where there'll be a higher earning growth also?
Of course, we need to have a line of sight on earnings growth for a simple reason. We want to make money. We just don't want to protect capital.
Right.
Okay. And on a commodity business or any business, right? When the industry is not doing well, profits fall. When profits are falling and the company is still expanding, when the cycle turns, you cross your historical profitability. So always use a template of historical profitability to current market price. and you'll work out your price earning multiple of that business. Historical peak profitability to market price.
So historical peak profitability and market price to gauge the current multiple that we should be looking at.
Yes.
Even though we have been talking a lot about steel, metals, other metals, cements, etc., do you see some opportunities or certain threats in investments like real estate space or hotels?
Oh, we've got real estate, lots of it. Not, I won't say lots of it, but we got real estate. We've been riding that cycle for the last 3.5, 4 years now. Post-COVID, no, during COVID. That was when a very large company IPO'd and we were there. So we like that space. I mean, real estate is the best inflationary hedge to anything. And if your per capita income is going up from wherever to wherever, that's one place that everyone wants a better, higher standard of living, and real estate always does well in that process.
And it looks like they still have legs to run.
Real estate players have picked up about 30,000 crores from the marketplace.
Okay.
In QIPs, follow-ons, etc., etc. When 30,000 crores of fresh capital goes and chase land bank at today's market price, you've got real estate inflation coming up. So anyone sitting with historical inventory is going to get a repriced of that market.
Yeah.
Okay. So 30,000 crores of equity investing chasing real estate definitely means that real estate prices are going to be inflationary. Where, how, I don't know, but I know it's going to be inflationary. Will we participate with this? I think we're at the beginning of the end of that cycle.
Okay.
Right? Beginning of the end of the cycle, because everyone's getting money. Like I said, it's creating a crowded territory. Everyone's getting money. So supply,
it's like the feast being divided right now.
So supply is now going to outstrip demand. Whether it will happen in 2 years or 3 years or 4 years, I don't know. But it's the beginning of
the end of the cycle. Again, when you look at a sector like real estate, what are the factors you look at while entering?
Ambitious promoters have a very clear line of sight on how to build out or market the projects, okay, have pricing power, preferably have no leverage, but real estate is very difficult not to have leverage because the whole chain is leveraged.
Right. Like if you have to now go back to certain things that people should be looking at, we wrap up with a few philosophies or strategies than anyone, because if you are right now catering to an audience that is trying to enter into the markets, trying to understand what really goes on in the economy, in the markets, with the companies, how are they related, what they should be looking at. I know with a lot of these answers, you've actually given the kind of things people should be looking at. But as a wrap up, anyone who is looking to invest, irrespective of the sector, what are the things they should focus on?
Mutual funds?
Stocks.
Okay. I mean, we do everything that a stock picker would want to do. It's very difficult because the first 10 years of my investing cycle, I lost money. Okay. You need to pay those tuition fees and you have to go through that. Right?
Yeah.
If you're coming to the marketplace now, or anyone who's coming to the marketplace in the last 5 years has seen a one-way street. That's a dangerous place to be in.
And most people who are in their first, second, third jobs, mid-20s, late 20s, have seen that.
So that's a dangerous place to be in. And I would just say for beginners or anyone getting into market cycles, in some format we continue to do the same thing. Buy category leadership, buy solvency, buy low price. Because at the end of 2024, or we are close to the end of 2024, if you invested in the marketplace anywhere between 2001 to 2024, you're only making money.
Correct.
It's neither a portfolio manager making money, neither is your skill set making money, everyone's making money.
Correct.
So it's a marketplace and the economy that's made money for you. If you're going to participate, be there in the next 5 years, I think you got to protect capital first and make that incremental amount of return. Because markets have been very kind with 30% plus returns over the last 5 years. That's a number that you don't, you wouldn't want for the next 5 years. I mean, it's nice to have it, but you wouldn't want because it's, I don't think it's there.
And the moment a lot of people who are new to the market start losing money, they lose interest because you only have interest when you're making money.
Yeah, you run out of money.
Yeah, so in that case, how should people be looking at protecting their capital and maintaining that interest?
I think, so if you have to win the game, you have to stay in the game.
Yeah.
First you decide. Okay, you have to win the game, you have to stay in the game. So stay in the game.
Any particular areas where you think opportunities are underlooked right now?
If you can find a new stock which has got a lot of value and growth, okay, it's the wrong place to be. Everything is discovered.
Out of all the sectors that we had been discussing till now, majorly steel, cement, energy, oil and gas, if you had to pick one sector that would deliver the best returns over the next decade, what would it be and why?
It's the energy sector very clearly. So it has to be oil and gas and electricity. I would be there because I think valuations at once at a certain spectrum are
cheapest.
Okay. They're cheapest and they're okay, but like I said, the terminal value of fossil fuels is, I would like to imagine, zero. But whether it is 2045 or whether it's 2065, I'm not taking a call on that. If it's 2065, then obviously the net present value of that of that number is higher. In safety of capital, that's the place to be.
And what's the one piece of advice you would give to the retail investors trying to navigate cyclical industries?
I mean, do what everyone does. Try not to buy it at the top.
Look at down cycles. Exactly what we started with.
Just be careful on how you price these companies. See, a cyclical business is an asset-intensive business. An asset-intensive business is put up, say, at 100 rupees. You can't pay 250 rupees because the market cap is there.
Correct.
Okay? You're overpaying for the asset value. So I put it in the other way. If the market gives you, for a 100 rupees investment, 250 rupees of market cap, this entrepreneur is going to put in another 100 rupees because it will be worth another
250.
So his invest capital is going to be 200 rupees and his market cap is going to be 500. And that Ponzi scheme will continue till your overcapacity.
Yeah.
Okay. And then D-Day arrives. Everything comes back to book value.
Yeah. With all of these things happening in the market right now, with where the valuations are, and also whatever is happening globally, if you had to take a step back and give the big perspective on the Indian markets and the valuations as a whole right now, what would that be?
So US is expensive, India is expensive, China is cheap, Europe is cheap. Okay, so you create a blend of all of these portfolios and you'll be okay. So you step back and you're buying a fully priced market. You have to be careful on how you navigate this entire thing and do not have significant expectations on returns going into the next 4-5 years. So when we put a portfolio together and we talk about focused equity fund, you have to focus on what you want to own and also focus on what you do not want to own.
Correct.
Because the returns are going to be so finite.
I think latter is what most people miss.
The returns are going to be so finite that you can't take a lemon in your portfolio. So focus for us is not just what you want to own, it's also what you should leave out. Right or wrong, of course, the next 5 years will tell us.
With that, thank you so much, Kenneth, for being on The Big Perspective and taking the time out to discuss all of these investment philosophies and strategies and also these particular sectors that we made you talk about, even though you wanted to diverge from them time and again. But thank you so much for taking out the time.
Thank you very much.
Thank you.